15%. That number is not just a policy detail. It's not just a tariff. It's a volatility engine, because a tariff regime that whiplashes doesn't just change price. It changes behavior. It changes timing. It changes inventory. It changes financing. It changes confidence. And when confidence gets hit, the market doesn't wait for economists to publish a report. It moves first and explains later. Now stack that with Iran war risk hitting the tape in a live escalation regime. And suddenly you're not watching a normal market. You're watching an event regime. And in an event regime, silver becomes the gauge, not because silver is better than gold, because silver is thinner, more reflexive, and it sits at the intersection of industrial friction and monetary fear. Gold can glide. Silver screams. One word only in the comments: gauge. If you think silver is revealing real stress, noise. If you think this is headline adrenaline that fades once the market becomes tradable again, gauge or noise. Pick now. No edits after the retest. We grade it. Quick guardrail, tight and done. Feeds print differently. Months print differently. I'm not claiming motive, just mechanics. Educational only. Now here's the whole video in one sentence so you stay locked in. First candle is chaos. Normalization is the verdict. And in tariff whiplash plus war risk, silver becomes the gauge because it exposes stress when the market refuses to normalize after the pullback. Two tells decide the read. I'm giving you the cheat code early so you don't get faked out. Tell 1, acceptance on the retest. 2, hourly body closes, holding the decision zone once liquidity normalizes. Tell 2, SWFTP, spreads, wicks, fills, tape, physical. Does stress shut off fast or stay on after the pullback? Acceptance plus SWFTP still on equals gauge regime. No acceptance plus SWFTP turning off fast equals noise regime. That's it. That's the process. Everything else is commentary. Now, why is 15% tariff whiplash such a big deal? Because tariffs are a wedge. They wedge buyers and sellers. They wedge domestic and foreign price signals. They wedge inventory timing. They wedge capital. And the most underrated part, they wedge certainty. In stable policy environments, businesses can plan. They can price. They can hedge. They can ship. But in a whiplash environment where people aren't sure what the final rate is, what exemptions apply, what in-transit rules apply, what enforcement window applies, planning gets replaced by scrambling. And scrambling creates volatility. Scrambling creates front-running. Scrambling creates inventory distortions. And inventory distortions show up first in the most sensitive materials. Silver is one of those materials because silver isn't just a metal. It's a component. It's a necessary input. Electronics, energy infrastructure, manufacturing, defense, data centers, all of it. So when policy uncertainty hits trade flows, silver doesn't just move because investors got excited. Silver moves because cost uncertainty and timing uncertainty hit the real economy. Now add war risk. War risk compresses time. That's the simplest, most important line you can remember. War risk compresses time. It turns maybe into right now. It turns I'll wait into hedge first. It turns normal liquidity into widened spreads, reduced size. And when time compresses, markets stop moving in steps and start moving in bursts. That's why this combo matters. Tariff whiplash is slow uncertainty turning into fast behavior. War risk is fast uncertainty turning into instant hedging. Both create stress. Silver becomes the gauge. Now here's the trap that kills people in this exact setup. They treat the first candle like truth. It isn't, because event regimes move in phases. Phase 1, liquidation, cash first. Phase 2, hedging, safety later. This is why you can see a spike and then a flush and then a spike again. Tariff whiplash can trigger liquidation because risk assets get de-risked, margins get tightened, and people raise cash. War risk can trigger hedging because tail risk gets priced, uncertainty rises, and people buy insurance. So you get the whip, spike, flush, spike again. If you chase the spike, you get wrecked. If you panic on the flush, you get wrecked again. So we don't chase, we grade. We grade after the pullback. First candle is chaos. Normalization is the verdict. That's your anchor line. I'm going to say it exactly 3 times in this video, and that's it. Now let's make silver becomes the gauge measurable, not poetic, because I'm not here to sell you a story. I'm here to give you a way to read the tape. Tell 1, acceptance. I'm going to give it to you in a 3-step mantra so it's ear-friendly. Find the breakout hour, markets close, mark the midline of the impulse. That band is the decision zone. Rule, after the pullback, 2 hourly body closes holding that band equals acceptance. If we get acceptance, the bid is real. If we don't, headline adrenaline. Tell 1. Tell 2, SWFTP, stress on or off after the pullback. Spreads, wicks, fills, tape, physical. After the pullback, did stress turn off fast? Or is it still on? Spreads, wide for hours or tight in minutes. Wicks, still long after the initial shock or shrinking quickly. Fills, messy execution or clean again. Tape, bursty air pockets or smooth steps. Physical, loosening on red days or staying tight. If 3 out of 5 stay on after the pullback, you're not in a normal market anymore. That's a stress regime. That's silver functioning as the gauge. Now physical is the edge, and I'm going to keep it short because you asked for pace. 1 SKU, 1 dealer, 2 numbers. Premium percent over spot, lead time. Normal market, red days loosen physical. Premium drops, lead time improves. Stress market, red days don't fix anything. Premium stays stubborn, lead time stays sticky. Paper can fake you in a day. Physical tells the truth over weeks. Now, why does the tariff piece matter so much for this physical behavior? Because tariffs don't just hit prices. They hit logistics. They hit what clears customs. They hit what sits in transit. They hit what gets delayed. They hit what gets pulled forward. And those shifts show up as weird bursts of buying, weird pauses, weird inventory behavior. That's exactly why tariff whiplash is different from we raised tariffs once and moved on. Whiplash creates confusion. Confusion creates precaution. Precaution creates hedging and hoarding behavior. And hoarding behavior is what makes physical markets tight even when paper markets whip. Now let's connect war risk to physical behavior. War risk changes shipping insurance. War risk changes energy risk. War risk changes perceived stability. Even if nothing hits a mine directly, risk premia rise. And in commodities, rising risk premia show up as volatility and dislocation. Again, not a prediction, a regime. Now, I want to drop the brand sentence right here because it's the thing people remember and it anchors the entire video. Silver is the lie detector. Gold is deep. Gold can glide. Silver is thinner, reflexive, positioning sensitive. So silver doesn't just tell you up or down. Silver tells you whether the system is normalizing. If the system is normalizing, silver calms down quickly after the shock. If the system is not normalizing, silver stays jumpy, spreads stay wider, and physical refuses to loosen. That's the gauge. Now, I'm going to address the most common objection you'll see in the comments before it derails the video. Tariffs will reduce demand, so silver should drop, maybe over time, in a clean model. But markets don't trade clean models in event regimes. In the short run, tariffs create uncertainty and front-running behavior. Companies might pull forward imports before rules tighten. They might change sourcing. They might hedge inputs. They might build buffers, and that behavior can increase demand for certain inputs temporarily. So the short-run effect is not always demand down. It's behavior unstable. And instability is exactly what makes silver the gauge. Now let's address another objection. War risk is being exaggerated. Maybe it de-escalates tomorrow. But again, the market doesn't wait for certainty. Markets hedge uncertainty. And when the tape is trading an escalation regime, the behavior changes whether you personally agree with the headlines or not. That's why we grade after the pullback, because if it de-escalates, stress turns off fast. If it escalates, stress stays on longer. Either way, the tape tells you. Now I'm going to give you a mid-video clock line because this is the single best retention and decision line for your audience. If stress is still on after the pullback, you're not in a normal market anymore. That's the clock. That's the pivot. Now let's talk about why this setup can turn violent, even if you're right, because event regimes punish leverage. When tariffs whip, margin assumptions change. When war risk hits, volatility spikes. When volatility spikes, spreads widen. When spreads widen, stops get swept. When stops get swept, air pockets appear. And air pockets create flushes that feel like the thesis is wrong, but often it's just phase 1 liquidation. Then phase 2 hedging arrives. So if you trade without a plan, the market will take your money in both directions. Now let's connect this to what you should be watching in the next 24 to 48 hours, but I'm going to do it in a way that doesn't dilute the 2 tells decide the read. 2 tells decide the read, 3 drivers decide the environment. Drivers, tariff clarity, war trajectory, retest behavior, but the read comes from acceptance plus SWFTP. So when you watch the environment drivers, you're not watching them to predict. You're watching them to understand whether stress will persist. Tariff clarity. Do we get clean rules and stability or ongoing exemptions, adjustments, confusion? If rules stabilize quickly, the trade friction fades. If rules stay messy, the friction persists. War trajectory. Escalation or containment. Escalation keeps time compressed. Containment lets stress unwind. Retest behavior. Acceptance prints or fails. That's your scoreboard. Now, I want to make tell number 1 more concrete for listeners who aren't traders because not everyone knows what impulse candle means. Here's the simplest way. Look for the hour where the move changed character, the hour where price stopped chopping and started moving. That's your breakout hour. Mark the close of that hour. Then take the whole move from that hour and mark the midpoint. That creates a band. That band is where the market decides real bid or headline spike. If, after the pullback, price can live above that band for 2 hourly closes, that's acceptance. If it can't, that's rejection. It's that simple. Now, tell number 2, the SUFTP checklist, this is what keeps you from being hypnotized by the quote. Because in stress regimes, the quote can be misleading. It can spike on thin liquidity. It can flush on stop sweeps. The supporting signals tell you whether the system is stable or not. So again, the 5 components: spreads, wicks, fills, tape, physical. And here's the important detail. You don't need all 5 to scream. If 3 out of 5 remain stressed after the pullback, stress isn't normalizing. That's a stressed system. That's why silver is the gauge. Now let's go deeper on the physical component, because this is what separates you from channels that only stare at charts. Physical is where the real world speaks. And in tariff whiplash, physical can get weird. Because import rules can cause delays. Because logistics can get jammed. Because participants might hoard inputs. So you can see a situation where spot dips, but physical premiums don't loosen. That's a stress signal. Again, not prophecy. A gauge. And your viewer doesn't need a terminal. They need consistency. 1 dealer, 1 coin, 1 bar, 2 numbers, premium percent, and lead time. That's it. Now, I want to address the idea that silver is both industrial and monetary, because that's why it becomes such a good gauge in this combo. Tariff whiplash is an industrial uncertainty shock. War risk is a monetary uncertainty shock. Silver sits between them. So when both hit at once, silver becomes the asset that reveals whether the system is normalizing. Gold can respond to war risk even if industrial conditions are stable. Silver responds to both, and because it's thinner, it responds violently. That's why it becomes the gauge. Now let's talk about what gauge regime looks like in price action, without giving signals or pretending we know the future. In gauge regime, you often see moves that don't give back easily, pullbacks that get absorbed quickly, long wicks that persist even after the first shock, tape that remains bursty, spreads that remain wider longer, physical that doesn't loosen on red days, and acceptance that prints after the pullback. In noise regime, you often see the initial move fades quickly, spreads tighten fast, tape smooths out, physical loosens on red days, acceptance fails. That's it. Now, 2 scenarios: bearish first, bullish second, always. Scenario 1, noise. Tariff whiplash hits headlines, war risk hits headlines, silver jumps because it's thin and everyone treats it like a signal. Then the market becomes tradable again. Stress turns off, spreads tighten, wicks shrink, tape smooths, physical loosens on red days, acceptance fails, no 2 hourly closes holding the decision zone after the pullback. That's a normal market returning. Silver was a gauge of headline adrenaline, not structural stress. Scenario 2, gauge. Tariff whiplash persists. Operational friction remains, exemptions and timing uncertainty keep trade flows unstable. War risk keeps time compressed and volatility elevated, so the system can't normalize. Acceptance holds, 2 hourly closes hold the decision zone after the pullback. SWFTP stays on. Spreads remain wider, wicks remain long, tape remains bursty, physical stays tight. That's a stress regime. That's silver functioning as the gauge. Now decision tree, gradable. Acceptance holds plus SWFTP stays on equals gauge odds rise. Acceptance fails plus SWFTP turns off fast equals noise odds rise. That's it. Now I'm going to talk about what can break the gauge regime, because that's what keeps you from becoming a permabull. Gauge regime breaks when uncertainty collapses. If tariff rules stabilize quickly and the market stops fearing sudden changes, trade friction fades. If war risk de-escalates and markets start pricing containment, time decompresses. Liquidity returns. Spreads tighten, tape smooths, physical loosens. That's how cooling happens. So silver becomes gauge is not silver goes up forever. It's silver reveals stress while uncertainty persists. Now I'm going to speak to the trader part of the audience for a moment, and I'll do it in a way that also helps stackers. The most dangerous thing in a stress regime is leverage, because stress regimes don't reward being right. They punish being sized wrong. Slippage increases, stops get swept, air pockets appear. You can have the correct thesis and still lose because you chose the wrong size and the wrong timing. So if you're trading, you reduce size and you trade the verdict, not the first candle. If you're stacking, you ignore the first candle and you focus on whether physical behavior is tightening or loosening. Same principle, different time frame. Now, I want to reinforce the accountability loop, because this is what makes your community feel real. You picked gauge or noise. Now you come back after the pullback and you reply to your own comment with what printed. Did acceptance hold? Did SWFTP stay on? Or did the market normalize quickly? That's how you stop being emotional and start being disciplined. Now, 3 things to watch in the next 24-48 hours. Only 3. 1, tariff clarity. Does the rule set stabilize or does the whiplash continue? 2. War trajectory. Does escalation continue or does containment calm the tape? 3. Retest verdict. Acceptance prints or fails. And the read comes from the two tells, acceptance plus SWFTP. Now, risk warning, it's not optional. Event regimes punish leverage. Slippage increases. Stops get swept. Air pockets appear. Correct thesis, wrong size, wrong timing, still loses. Know your camp, stackers, time, and discipline. Traders, structure and risk management. Now, I'm going to close this the OG way. Mnemonic, and then the thesis snapback. Tariff, war, verdict. Tariff whiplash creates friction and uncertainty. War risk compresses time and turns markets into stress tests. Verdict is not the first candle. First candle is chaos. Normalization is the verdict. Gauge or noise? Drop your word now. Tomorrow we grade it. If you guessed wrong, you'll know exactly why, because the tape will show it. Logic over hype. Always.